So it's pretty straightforward. I think this is probably, generally speaking, one of the most easy to identify, because normally you're going to have a T4 slip, right? The complication with employment income is that there could be other, maybe let's say fringe benefits, right? Extra things your employer gives you that may or may not show up on the T4. If you are your own employer, right? If it's a small business and you're both the employee and the employer, or sometimes there can be debate about whether it's employment or self-employment. So there's always more wrinkles to it. But in the general scenario, it's pretty straightforward to find out somebody's an employee and they're getting a T4. So employment income is covered, of course, in the Income Tax Act. There's definitions, different things that are going to be included. We have stock options that your employer may provide that are also considered a part of employment income. And in Section 8, we can also potentially have deductions from our employment income. So again, for most people, it might be as simple as I have a T4 and I'm just going to enter it into my tax return. But for others, there could be more layers of complication to that employment income. One of the important aspects of employment income is that employment income is done on a cash basis. So in other words, when the cash or the benefit is received is when it's recognized. This would be the exact opposite. So cash, that's for employment. Accrual, this is what we do in accounting, right? You guys should be familiar with accrual accounting, and that's what we're going to do for business income. So there is a difference, and the difference between cash and accrual accounting is all about timing, right? So most simply put, in if you're looking at accounting income, your accounting income could include revenue where you haven't been paid yet, right? That's why we have, we have a balance sheet, and we have accounts receivable, and we have accounts payable. There's stuff that you've recognized the revenue and the expense over on your income statement, but you haven't actually got the money yet, so it sits as receivable, or in the case of a bill you need to pay, sits as payable. So that whole accrual accounting, that's what we use for business income. So if you do have unincorporated business income, that's our Chapter 6 stuff, then you'll use accrual accounting. Over here for employees, in our Chapter 3 stuff, we're going to use cash accounting, meaning when you got paid. So here's an example. In other words, if you're an employee and you work, we're always trying to get a cutoff, right? Because everything is to December 31st. So if you're an employee and you work from, say, December 16th to December 31st, but then you get paid on, say, January 4th of the following year. So say this is 2022, and this is 2021. If you are an employee, that income does not hit your tax return until 2022. It's cash, it's when you got paid, not when you did the work. Accrual accounting is the exact opposite. It's when you earned the income. So if it was business income, you would recognize it into 2021. So it's all about when you received the cash or the benefits. Now, when does that matter, right? So the T4 slip itself will only include what you've been paid. But what about other things like bonus arrangements? Well, we have an example here, right? Because often you'll be being paid a bonus based on the results of the previous year, right? Did you meet certain sales targets or profit targets the year before? Maybe if you're in management or sales or something and you're getting some sort of a bonus. So let's have a look at this. So on July 25th, 2020, Martin Limited declares a bonus of $100,000. So to one of their employees, Roger Jones. So this is July 25th, 2020. Now this is a corporation. Corporations can have year ends that are different than December 31st. So they have a fiscal year end, doesn't have to follow the calendar. So this company's year end is July 31st. This bonus gets declared just before July 31st, so just before the fiscal year end. So let's, so we'll just put, I'm just going to write that date down here on the slide. So July 25th is when they declared. Oop. So we have a couple of examples here for this. Declaring the bonus just means they said, okay, what's the guy's name here? Okay, Roger, you're going to get a bonus. You know, you did good work this fiscal year. We're going to give you a bonus. And on July 25th, they declare you're getting this bonus of $100,000. But that doesn't mean he got paid the bonus yet. So the question is, when will he get it paid? And how does that work for the business? And how does that work for the individual getting paid? So if the bonus is paid after December 31st, 2020, because remember, December 31st is what's relevant for the employee, and July 31st is what's relevant for the corp. So if the bonus is paid after December 31st, 2020, then the employee is just going to include that in his income when he receives it. So even though he earned it in 2020, it's all about when he receives it. So if he receives that payment in 2021, then he'll recognize it in 2021. In this example, I should put that was 2020. Slash here. Right, so July 25th, 2020 is when it was declared. So it's all about when will it get paid. Now, I'm gonna just make note here for you guys. In your text, it is on page 83. I'll make a note in the chat here. So on page 83, there's a nice little chart for bonuses. So if you look at that chart, excuse me, on page 83, you'll see what is called a standard bonus. And a standard bonus is one that is paid within 180 days of the employer's business year end. In that case, the employer deducts it when it's declared, and the employee includes it in their taxes when it's received. Because remember, this is a deduction for the employer. They're paying you extra wages. So it's all about timing. The reason why we're talking about any of this is timing and the difference for a business, timing and the difference here between your accrual and cash accounting. So that's why, if you look at that little chart and you see the dates, that's why they mention here paid after December 31st, 2020, but before January 28th, 2021, because the next one is called other bonus. So if you surpass that 180-day limit, so an other bonus is paid more than 180 days after the employer's business year end, but before 3 years after December 31st, at which the bonus was earned. So if they pass the 180-day limit, then the employer can't deduct it until it's paid, and the employee still includes it when it's received. So that would be called an other bonus. So as long, basically this is good for the employer. So as long as the employer, they can declare the bonus, they can get it deducted into the current year end, which in theory the bonus relates to. But then for the employee, they don't have to pay until they get the money. So if you keep within that 180 days, this works perfect for everybody. Just looking at Danielle's question here. If the bonus was declared on July 25th, would, I think there's probably an it missing there. If the bonus was declared on July 25th, would it be an accrual until it's paid? Correct. Yes, that's correct. So if you're thinking about the accounting, basically it would be sitting as a bonus payable on the books. You would debit the expense account, claim that deduction, and credit your bonus payable. So it'd be sitting on your balance sheet as a bonus payable, basically accrued. So that's the accounting perspective. So sometimes, so the big thing with tax and accounting is sometimes they align and sometimes they do not. Obviously, we need to use that accounting information as the initial basis of our tax when it comes to business, but then we can have adjustments past that. And we'll see that even more specifically when we get into tax 2 with the corporate stuff, but we will talk about that some in chapter 6 when we talk about business income too. So we're starting, a lot of this, you look at it from both sides because you've got the employer and the employee. So for the business, they can deduct it when it was, when the cost was incurred, when it was earned by the employee. For the employee, it's all about when they receive it. But there are some exceptions to that. So that's what that little chart in the text, it's called figure 3-1 bonus arrangements. So that one is what you're going to want to see. Can I? It's figure. Figure 3-1. So as long as it's paid within that limit of 180 days, then the employer is all good. If they don't pay it, right? Because they have to eventually pay it. If we didn't have any rules in the Tax Act about when this got paid, then people could just accrue a whole bunch of bonuses, claim the expenses, and just never pay them, right? So nobody would ever pay any tax because they'd just always accrue a bunch of expenses that they never paid. So they do eventually have to get paid. So that's where the timing comes in. If you pass the 180, then the employer also just has to deduct it when it's paid. They don't get to that benefit of claiming it kind of early, claiming it based on the accounting rules, really. So there's case B. If the bonus is paid after January 27th, 2020, but before July 31st, 2022, we're going to deduct it when it's paid for the employer and received for the employee. Now, the reason for these far out dates here of 2022, that's the third option, which is what we call a salary deferral arrangement. So if this income is going to be earned, but it's not going to be, like, it's going to be earned during the year, but not paid for more than 3 years, 3 years calculated from the end of the calendar year, not the fiscal, the calendar. In that case, if this is officially a salary deferral arrangement, then the employer can deduct it when it's declared, and the employee will actually include it when the services are rendered. So this is an exception to that kind of general rule. We will talk a little bit more about this in chapter 10. So we'll put a pin in that for now. You're not going to get asked a big question about salary deferral arrangement here, but you may see inside of a question, it might comment about a bonus. So if you're calculating tax for the employee, you need to make sure to properly include the bonus when it's paid outside of a specific salary deferral arrangement. So in your text on page 87, it gets into the topic of employee versus self-employed. Page 87 has some information there. Employee versus self-employed. So like I said, I mean, often it's just like you would have a kind of a ordinary resident. Like I said, I would be an ordinary resident of Canada for tax. Always lived here, always worked here, went to St. Mary's, set up my own shop here. Nothing, very easy to determine that my residency for tax is in Canada. Likewise, for a lot of employees, it'd be very straightforward, and they have their T4, and it's easy peasy. But there's always exceptions to that. You can always have our gray area in the middle. So this is one of those spots where we have, possibly some determination to do. So you can often have, as part of your role as the advisor to your clients, you may have to help them determine if somebody that's providing services to them is an employee or if they are self-employed. So often this will be coming to you from the employer side. They'll be saying, I'm paying this person. Should I be paying them as an employee or as self-employed? And there are, potentially some serious implications of this. Usually where this happens is, the parties involved think that maybe they can, get themselves a better tax situation by setting it up a certain way. So maybe the employer is trying to help out the worker. Basically, well, if I'm going to use the correct terms here, you're going to have a payer and a worker. because we're trying to determine if they are an employee or self-employed. So until we know that, really what we do know is that we have someone who's doing the work and someone who's paying them. We have to determine what that relationship is. So from the employee's perspective, or from the worker, probably a better word, from the worker's perspective, they may be motivated to be considered self-employed instead of an employee. A self-employed person, as we will learn in Chapter 6, has got a lot more availability of deductions they can claim, deductions to reduce their income. Self-employed people don't have any withholdings, right? So if you don't want to have any of that tax taken up front, well, self-employed is better. Now, technically installments would still apply, right? That we learned about in Chapter 2. Self-employed don't pay EI premiums. In theory, you could look at that and say that's good, but that also means you can't participate in EI. CPP, on the other hand, if you're self-employed, CPP, you got to pay it twice, because you have to pay the employer and the employee portion. So you are your own employer. So you actually have to pay extra CPP. So that's one downfall. You know, we got to look at the pros and cons. Fringe benefits. You're not normally going to get fringe benefits. That would be a good thing. But you're not normally going to get those as self-employed. Now, if somebody's up to nefarious ideals here, there's an opportunity for tax evasion if you are self-employed. Meaning, there's in the case where you're self-employed, there's going to be no T4, right? Now, sometimes for self-employed, it is required to get a T4A. Sometimes there will still be a slip, but sometimes there won't be. So that opens up the possibility, of course, of not reporting your income. If nobody else is reporting it for you, then you have more opportunity to not report it yourself. So this is not a recommendation, because that would be illegal. That would be considered tax evasion. However, from the not so well motivated person who wants this arrangement to be self-employed, they may be wanting to underreport their income. They may also want to, say, hide that income from a former spouse, from the ex. So I've seen these kind of scenarios run up where, an employer thought they were doing a favor. So, I'll use these phrases: the payer, the company, thought they were doing the worker a favor by categorizing them as self-employed, by not taking the withholding, by not taking off the EI, by not providing a T4, and just calling them self-employed. So they thought they were, quote unquote, helping the worker because, one, they would be able to pay less tax. Two, maybe the ex wouldn't be knowledgeable to their income because it was quasi under the table, meaning it would just be whatever was reported. So there wouldn't be paychecks. There wouldn't be ways for the ex to be knowledgeable about their income if a portion of that was supposed to come to them in support payments. So there's really a whole bunch of trouble that this, bad motivation that could be involved here. What ends up happening 99 times out of 100 in these scenarios is that the problem here is going to be for, firstly, the payer. They're the one who's going to get in trouble here, first off, because if they go under audit, one of the things that CRA will look for under, say, just a routine payroll audit is what individuals are getting paid by this company. And if they find individuals that are getting paid off of payroll, just straight checks, then they'll want to know who these people are and what they're doing. And they can look at those workers and do an assessment on their status. So they can retroactively decide that these quote unquote self-employed people were actually acting as an employee. Therefore, they owe the missing taxes. They can't claim the deductions, all that stuff for them. But for the employer, there's going to be the employer portion of CPP that wasn't paid, which can actually be significant if you have a number of employees. I had a client many years ago, probably like a decade ago now, that had some arrangements with a few people like this. They had a whole bunch of employees, but then they had a handful of people that they were just paying straight like this, trying to do them, I guess in their mind, they were doing them a favor. But ultimately, where that ended up is that once those people weren't working for them anymore, and then they were trying to get EI, right, go on unemployment, well, guess what? They had never paid any EI. So if they never paid any EI, then they wouldn't qualify. So those same people that accepted being self-employed because it was better for them will instantly change their mind and say, no, I thought I was an employee. I had no idea. I didn't know what was going on. And, frankly, just play dumb at that point. And so that can also trigger an audit and a review and an assessment. And in that one scenario, that client, I think the bill was something like $70,000 worth of CPP because it was over a number of years for a number of employee or workers who really were employees. So it becomes very important always as the advisor to try to give as much good advice up front so that our clients understand how this all works, how the determination of employee versus self-employed is done to make sure that they aren't paying employees as self-employed, because it's always going to go down a bad road for them. So they have to understand what they're working with here, how this determination is done so that they can do it properly at the start. And even if somebody is saying, hey, can you please do this for me? They understand that they can't do that, so they don't make that mistake. Because it can get a little bit complicated. And it is a gray area. So sometimes the employer can be motivated too, right? They don't have to deal with CPP. They don't have or any of payroll taxes, right? There's always employer portions, plus it's just a hassle. So, there's that. They don't have to pay any extra benefits. There's a lot of employment legislation that, gives, rights and things to employees that a self-employed person wouldn't have, protections in employment law. So they don't have to worry about any of that. It's really less of a commitment. So this is kind of the perfect storm of a lot of the worker and the payer both kind of think it's better. So that's where the motivation comes in. So how do we? So here's what you guys. That's why it matters. That's the context. So what you guys will need to be able to do in this course is a little bit of determining if in a scenario, do you have an employee or do you have a self-employed person? So this is another, so through the course, we'll be doing a lot of number crunching, but we also have these kind of softer questions. So this would be similar to the type of short answer questions that you would have for residency. So you're determining, in chapter 1, we were determining residency. In chapter 3, you can have questions where you're determining and having to do a short answer as to, is this person an employee or is this person self-employed? The implications of that are what we were just discussing earlier. So how do we do this determination? How would CRA do it? And how can we do it, hopefully, up front before people start getting paid? So once again, we have our old friend here, intent. So just like with residency, it matters what the intent of the situation is. Further to that, we do have a list of other considerations. And again, there can be plenty of gray area here, and we may have to just kind of have a balance of the evidence, right? This is the kind of thing that could go to court and has gone to court, right? So again, we'll look more at court cases in tax too, but you could have a court case about this topic, right? Somebody says, I was an employee or I was self-employed, or the employer saying one or the other, and they end up in court debating that. So that is possible. So when we get into so intent is important, that's one. But what about these other specific considerations? So we have a list here, and this is all kind of detailed on page 87. I should actually first, I should also mention at the bottom of page 86 is where it, in paragraph 3-38, that's where it talks about intent. I'll read a little bit of that for a second for you. It says, the general approach to distinguishing between an employee and an independent contractor is the question of whether an employer-employee relationship exists. As there is no clear definition of employer-employee relationships, disputes between taxpayers and the CRA are very common. So again, this comes up a lot. To avoid such disputes and to assist taxpayers in determining whether or not an individual is an employee, the CRA provides a guide titled Employee or Self-Employed. So that's RC 4110. So again, these things that CRA puts out are not law, but they are guides. They are assistance as to how CRA will make the determination. So if you want to play ball with the folks who administer the Tax Act, you'll want to stay in line with how they're going to operate. So that if you wanted to look at some of this, where this information is coming from, it's that RC 4110. If you just type that into Google, you'll be able to find that document if you wanted to read a little more on the topic. It also goes on and says here, as described in the guide, the first step to making this distinction is to determine the intent of both parties. Both the worker and the payer must be clear as to whether there is a contract of service, that's an employee-employer, or a contract for service, which is a business relationship. So unfortunately, once again, we have these phrases that are near identical, kind of like non-capital loss and net capital loss. In this case, just to make things difficult, so contract of service is the employee-employer, and contract for service is what you would do in just a regular business relationship with a person who is not an employee. It says, this intent may or may not be in the form of a written agreement. So something like an employment contract or a contract for self-employment. Now, if we get into on the slide here, then it talks about the other considerations. So basically what this means is if we have a breakdown in the agreement here between the two parties, which is often, this is often what sparks this issue. So if we have a breakdown in that, meaning the worker is now saying they're an employee because they want to go get EI, and the payer is saying, no, I was not, this was just a self-employed thing because they don't want to pay these extra CPP and all this. Well, now we have a disagreement. They both don't agree on that original intent. So we have to go further and look at the other considerations. So those are given on page 87. And the first one is control. So for control, usually, if you've worked in a job, you'd understand that, your employer usually has quite a high level of control over how your work's going to get done, what methods you're using, how exactly you're going to do all those tasks and the way it's going to be done and when it's going to be done. Like, they control the whole situation. In a self-employed situation, that would be to a much smaller degree, right? You're going to hire somebody to do a job. There's going to be some parameters around, what that job is and some sort of a deadline, but it's not going to be the same level of direct control. So the more we lean towards the payer controlling the way the work's done and the methods used, the more we would lean towards an employee-employer relationship. So you can see immediately that this is kind of a gray topic here. It's not necessarily obvious. The second one is your tools and equipment, the ownership of that. So normally, in an employee-employer situation, your employer would pay for and own all the gear you're using to get the job done, right? You work in a factory, you don't bring the equipment with you to do your job, it's there, right? There are some exceptions to this, in certain trades like mechanics and things like that, it can be that they own their own tools. So there are some exceptions, but generally speaking, not in those specialized areas, generally speaking, the employer is going to supply the equipment, the tools required for that employee to get the job done. If I hire a landscaper to work on my backyard, they provide the gear. I don't have the gear ready and waiting here for them. I don't have backhoes and stuff here for them to do that. So that's our ownership of tools. That one's pretty straightforward. The third one, ability to subcontract or hire assistants. So I guess the way I like to put this one is, if you work at McDonald's, you can't hire your friend Pam to come flip the burgers for you. It's you they expect to show up, right? If I'm working there, they expect Andrew to show up, and I can't just get somebody else to show up with my name tag on. Whereas, in that instance of hiring a landscaper, you hire the company and they send whatever crew comes to do the work. Now, of course, again, there can be gray areas here. There could be part of the contract for self-employed that involves certain specific key people to do certain things. That is possible, but the ability to subcontract out and hire assistants certainly leans more towards the side of self-employed. And none of these items are kind of deal breakers. These are all basically, balance of the evidence that's there. You're going to lean a little bit one way or the other, and it could be a mix. So you're going to kind of go through this list when there's a debate opened up about it. You're going to go through this list and kind of check. Like, how many of these are leaning towards self-employed and how many are leaning towards employee? The next one, and make a broader determination. The next one on the list is financial risk. So normally speaking, employees, when you're an employee for a company, you're not taking any financial risk, right? Whereas a self-employed person can incur losses, right? We were talking about those business losses and things. A self-employed person can incur a loss if their fixed costs, if their expenses are more than their revenue, they can lose money. Whereas an employee, generally speaking, isn't going to lose money. You may have a few employment expenses that you claim or whatever, but you're making money. You don't have that financial risk involved. Responsibility for investment and management. So if you're an employee, usually, and there's always exceptions, usually you're not investing in the business. You're not normally putting in capital into the business. So alternatively, if an individual has made an investment in a business, if they're active in managing the business, they would generally be considered a self-employed person. Now, that doesn't mean that, again, you can't have an employee who might maybe buy shares in the company, which technically is an investment in the company, but that's a different type of thing. And the last one is opportunity for profit. So profit, same as a loss, right? Same as that financial risk of a loss. What about the opportunity for profit when revenue exceeds expenses? So in an employer-employee relationship, the employer assumes the risk of the loss and the possibility of profits, right? They're covering the expenses, the wages, the benefits, all this kind of stuff. The employees aren't taking on any risk. So they just get their salary. They just say, here's how much you're paid. You're paid for this many hours of work, or you're paid for this much every 2 weeks as a salary, and that's it. It doesn't matter how healthy the business is. Now, again, you might have bonuses and things like that, the profit sharing things. So there are some special scenarios, but generally speaking, the employee is going to have little or no opportunity to access the profit of the company. Generally, they're just getting paid their wage or their salary. So this contains a lot of kind of gray area, and you have to just kind of look at the balance of the evidence here. So you can see why this could end up being a debate in court, because there could be a lot of money on the line, and it can get messy with a lot of gray area. So you'll have some basic scenarios to look at and determine, are we looking at an employee or a self-employed person? The last thing that I'll say on this from the perspective of the text here, there's a little bit more here on the bottom of page 87. After it goes through all those, it also points out that it's really important to make sure that there's kind of a little checklist basically at the bottom for what you should make sure to do as the employer, excuse me, to ensure that self-employed status will be recognized. So just a checklist of things you can do to kind of try to avoid falling into these pitfalls. So one, the individual that is working for you should have their business registered for purposes of GST, HST. That would be how someone would behave if they were operating a business. So they should be registered. If that individual also provides the same services to other companies, that would be an effective argument. Not 100% of the time, but again, that's going to help and lean towards being self-employed. Also, if they're advertising their services, right, offering it to other people, even if they haven't, maybe, everybody's got to always get that first client, right? But if you only have one client and you're starting your business going, well, you should be advertising and attempting to get other clients. This is how someone who is a separate self-employed person would behave. That would all go to evidence of intent. To the extent possible, you should have that individual be covering their own overhead. They should, be supplying their own equipment. They have their own phone and supplies. You shouldn't be covering their kind of overhead costs, their fixed costs for them. The person should be invoicing you, preferably just kind of on a like not every 2 weeks type thing. Like it should be more, when projects are done, that sort of thing. You could have a lawyer prepare an independent contractor agreement. And if possible, have that individual actually incorporate. Have them create a separate legal entity that is the business that you are dealing with. So all of those things can really protect the employer, because it makes it real clear when you have all those things going on. It makes it real clear what the intent is and makes it less possible for that person to argue that they were an employee. And that's often where this comes again. The person enjoyed the arrangement while it lasted, but now they're out of work and they're trying to get EI. And they can't get the benefits because they weren't paying in. So that's often where this all kind of lands in the end. If you, there's been a large number of court cases on this topic. And if you want to avoid the problem up front, you can go to CRA for what's called a ruling. And you can do this in other areas as well. If you've got an issue that you just, you want to make sure that you and CRA are on the same page ahead of time, you can simply go to CRA and get a ruling. Now, I say simply, you got to go through the process and it takes a little bit of time. But if you really want to make sure that you like, they can't, in other words, if they make the ruling, that makes it very difficult for them to come back and change their mind later on. You've behaved based on how they ruled, right? So they've said, yes, this person is an employee or they're self-employed, and then you can take action based on that. So that is another option for taxpayers. And again, you can do that in other areas besides the employee self-employed situation. So there is a question here, which is assignment problem 3-2. 3-2, it's at the bottom of page 128. I want to have a peek at that one. It starts at the bottom of 128 and it continues with most of the details there on page 129. Did anybody have any questions before we roll into that question? All right. So I'll read a little bit from the question here. It says the Alberta Motor Association, that's the payer, carried on a business of training and providing instruction to individuals who wanted to obtain a vehicle operator's license. So we have Mr. Bourne in this case. So this is a case that relates to, there was a court case. So that's why they're using the terminology here, calling Mr. Bourne the appellant. So he's the one who's appealing a assessment. It says he had an arrangement with the payer to provide these services. So it's basically driver training business. On page 129, it goes on to talk about how the payer treated Mr. Bourne as an independent contractor from 2018 to 2020. And it says that Mr. Bourne was claiming that he was an employee for the Alberta Motor Association in 2021, or sorry, in 2020. So here we have that scenario where you have a payer and a worker, and there's some debate as to the status. The two do not agree. Let me pull up solution here. So the first thing that we look at, so the text does get into, there's a big giant list of a whole bunch of bullet points that we can run through about this, but the first thing that we look at, same as we would with looking at residency, first thing we're going to look at is the intent. So the most important factor in the employer independent contractor decision is the intent of both parties. So the court noted that there was a disagreement between the parties as to the intent. Because of that, it becomes necessary to look at all of the facts to determine the legal relationship. So it sounds great. You say, well, as long as we both have the same intent, everything's fine. But in reality, that intent can change, or somebody can say later on that that wasn't, right? There can be a dispute about it. And this, the perfect example of it is when somebody's trying to go get EI, right? They want to get those benefits they would have got if they were treated as an employee. Because employees have all these extra protections and benefits and things. So number one is intent. Once we've cleared that, then we're going to go ahead and get into the list of all the other stuff. So the question rolls through a whole whack of information, but that will be kind of explained here in the we'll break it down into these categories. So I'm going to run through the question real quick here. And if you guys have it in front of you, you can follow along. So it says, the facts in the case are as follows. So the payer operated a membership-based association. The payer has clients who want to get their license. The appellant, right? So that's the worker. They're appealing the situation, so that's why they're called the appellant, but that's the worker. So I'll just say the worker. The worker was hired as a driving instructor. The worker entered into a written contract with the payer stating that they were a contractor and not an employee. The worker had been under contract with the payer since 2018. The worker earned $26 per hour. The worker also received fees for new bookings, student home pickups, and a fuel subsidy, so they got the gas covered. The worker was sending invoices to the payer. So you'll notice these things, some of these are on that list we were talking about at the end there. You know, here's some things the employer can try to do to protect themselves, get a contract, pay them properly, make sure there's invoices, that sort of thing. Those are things you should do, but we'll see if that's enough. We have, so the worker was invoicing. The worker did not receive any employee benefits, no health, dental, vacation pay, the stuff employees would normally get. The payer did not guarantee a minimum amount of pay. The payer's hours of operation were 8 to 5 Monday to Saturday. So some of this stuff is not going to be, you know, incredibly relevant, but it talks about what the payer's schedule was versus the workers. The worker was able to set their own schedule. So that we'll put these things in case, but let's give you the lowdown here. So the worker was able to make their own schedule. They could work anytime between 8 and 10 p.m., 8 a.m. and 10 p.m., Monday to Saturday. They did not have a set minimum amount of hours required to work. The worker kept their own record of how many hours they worked. The payer provided the names of the students. So they kind of said, here's who is looking to be taught. The worker contacted the students directly to schedule their appointments. The payer provided the appellant with an in-vehicle lesson guide, so kind of how the lessons should be done. The worker chose the routes where they were going to drive. So it was the payer who said how to do the teaching. The worker decided where to drive. The worker used their own, was able to hire their own helper to do any admin related to it. The worker provided the vehicle. So that is the major tool involved. So basically they brought their own car to do the training. The payer provided signage, mirrors, traffic cones, and special emergency brake. So like that extra brake so that the instructor can hit the brakes if they need to on their side. The worker paid for the installation and the removal of the brake though. So the payer provided the brake, but the worker had to get it installed. The worker incurred expenses, so the vehicle expenses, vehicle insurance, and something called a driver training endorsement. So it must be, maybe they had to get a certificate or something to be able to do it. The worker's vehicle expenses included insurance, maintenance, and fuel. The payer's intention, so there's intent, was that the appellant was a contractor, not an employer. That's what the payer, that's what their intent was. The worker had a GST number. The worker charged GST. The worker had also operated their own taxi business since 2002. The worker maintained their own business books and records, so they did their own accounting and they declared all of that business income on their 18, 19, and 2020 income tax returns. So this is the kind of thing you could expect. Here's a whole bunch of information about a scenario. And your question, what you need to do is say, should Mr. Bourne, the worker, be viewed as an employee or as self-employed, independent contractor? Those are all kind of synonymous. So employee or self-employed. Those are what we're trying to determine. So all of that information is kind of summarized here in the solution. So again, first we're going to look at the intent. And although there is clear evidence that the payer intended this to be a self-employed arrangement, there seems to be some disagreement on that intent. So we have to look at the rest of these to make a determination. So under the category of tools, we know that he provided his own car. So he was the one who provided the major tool to be used. Under risk of loss, could the appellant have loss? Well, he certainly had liability. He's driving his own car. If there was any issues there's potentially some loss. If the vehicle was crashed or whatever. The appellant was, or the worker here, was also incurring vehicle expenses, insurance, maintenance, fuel. So when you're incurring those expenses, it is possible that your expenses could exceed your income. There would be fixed costs of owning the vehicle as well. We have these other expenses like liability insurance, driver training endorsement. Also, the worker paid for the installation and removal of the emergency brake. So all of those things were costs that in theory could potentially create a loss. So far, if we look at tools, that, so let me scribble down here. I would say as far as the tools, that is leaning towards self-employed. As far as the risk of loss, it looks like that's leaning towards self-employed. I mean, maybe there's not he'd have to just make sure to do enough work. So there is some risk there. It might not be a high risk, but there's some. Chance of profit. So the more hours that he works, the greater his chances are of making profit. So, if he was an employee, he would just get paid for his hours worked. But as a self-employed person, the more he worked, to cover those fixed costs, then, in theory, there could be some profit. So it seems, again, like we're kind of leaning towards self-employed. As far as control, the worker had no set schedule. They could choose their own routes. So, sorry, I should, the way that they've laid this out, this is all the stuff that leans towards being an independent contractor or self-employed. We're going to hit the other side next. So I keep writing down self. Really, everything here is the stuff that weights towards self-employed. The worker could work for anyone else if they wanted to, right? Except as a driving instructor. So, they weren't tied, but there is some rules there. Behavior as an entrepreneur. Well, he certainly behaved like an independent contractor, right? Switch to pen. He invoiced. He charged GST, HST. He did his own books and records, and he reported his income as business income, claimed the expenses. So certainly behaved as such. So all of that stuff all points in the direction of self-employed. Now, what about employee? Well, we did have one tool, a much more minor tool, which was the vehicle signage, mirrors, traffic cones. So these kind of smaller tools and the emergency brake were provided by the payer. As far as control goes, the payer was providing the guide, which is how the worker was supposed to do the training. So the methodology was under the control of the payer. So you were supposed to comply with that methodology. So the appellant could hire an assistant, but couldn't have someone else replace him to do the actual training. So same idea as, you couldn't have someone else come flip the burgers at McDonald's. Not without the express support of your employer. So, and that's it. So you'll notice here, we have a very short list of things that were pointing at employee status. Like, there wasn't much. They provided a little bit of stuff, and a guide as to how to do it. Really kind of minor in the big scheme of things. We have a lot, there's a wealth of evidence here leaning towards self-employment. So the Tax Court of Canada in this case made a decision. So they're saying here, here we have an appellant, the worker, who, if I accept his testimony, was an employee, even though he behaved for a number of years like an independent contractor, and yet performed his services in his own vehicle, paid for the installation and removal of the emergency brake. Provided by the payer, incurred operating expenses, included vehicle expenses, paid liability insurance, and the driver training endorsement, effectively had exposures to all kinds of liability. If anybody got injured, if the car was crashed, any of that stuff, did not have a set schedule of hours or days he could work, and in a way set his own deadlines and priorities. So it says, I cannot find in these circumstances that the existence of some degree of control by the payer over the appellant outweighs the overall view that the appellant was in a business of his own account, independent contractor. So in other words, they're saying that he was an independent contractor. He was self-employed. Whoops, I keep forgetting to switch to pen. So the decision was that this guy is self-employed. There was just too much evidence. The small bit of control that the payer had over the methodology, that little training book, and they provided a couple tools, that in and of itself was not enough. So really this one seems like a bit this is pretty much a slam dunk, this one. It could get more difficult, but this is pretty clear that this person was self-employed. I see that we are at 9:44. So we will continue next class talking about Chapter 3. I'll also point out to you there that assignment number 2 is available and online for you guys under content, assignments, or if you click into the Dropbox itself, there's a link there. Assignment number 2 covers chapters 3 and 4. So that's the rest of the material up that will be going up to the midterm. The midterm will be chapters 1 through 4. So assignment number 2 is available for you guys to start working on it in advance. It is due February 6th. And so you can be following along on that. We will continue looking at the calculation of some benefits next class, like vehicle benefits, talk about employment expenses, and keep working through Chapter 3. All right. Thanks a lot, guys. Have a great rest of your Monday, and we'll see you on Wednesday.